Welcome in, Mr. Moneyman here. So today I'm going to be talking about a topic that may hit close to home for a couple of people, and that's debt. Now you may be thinking, what about debt? Debt is a simple concept. The less you have, the better, right? Well, at least that's what Dave Ramsey says, and he's so popular, so he must be right. Now, I think that's where a little bit of education can come into play, because I'm a firm believer that there are two types of debt. Good debt and bad debt. So good debt is any debt that you can use to increase your net worth and generate income. Examples which include real estate or certain small business loans, when used correctly, of course. Bad debt, on the other hand, is any debt you are taking on to purchase depreciating assets. Examples which include car loans, designer clothes, and usually credit card debt. Now we're going to get deep into all of this real soon, but before we do, I just want to quickly remind you to smash that like button below, and don't forget to subscribe to the channel so you can stay up to date with all of my future content. And if you're new to the channel, welcome in. I hope that I can provide you some real value and get you on your own path to financial freedom. But enough about all that. Let's get started. So right off the bat, I want to tell you about what I have learned regarding Dave Ramsey and some of his investment principles regarding real estate. They are bogus, and they are not realistic for the majority of investors. If you don't know much about Dave Ramsey, go watch some of his videos. All he touts about all day is that you should be operating all of your businesses and investments with all cash and never use any sort of debt or leverage. Well, Dave, I'm sorry, but you are wrong. One of Dave's main philosophies regarding real estate is that you should buy them with all cash, or you should pay them down as aggressively as possible so that you don't have to hold any debt on them. Now, I don't know about you, but buying a property with all cash sounds about as appealing as buying a stock that's going to go down to zero. But anyways, throughout this video, I'm going to be going through all of the reasons why you should keep debt on your property and why this actually benefits you due to the power of leverage. Specifically, we're going to be talking about how leverage works and the benefits of keeping a mortgage balance, as well as how paying down your mortgage does or doesn't affect your rate of return. So leverage, what exactly is that and how does it relate to real estate? So leverage basically means that you're going to put down a relatively small amount of money in comparison to an asset's price, and you're going to use somebody else's money, usually a bank, to fund the majority of the asset for you. When you do this, here are the potential benefits. First, you get to use a relatively small amount of money, sometimes as low as 3.5% to get into a big asset. An asset where if it goes up 10%, you're making 10% of the entire cost of the asset, rather than just a small amount of money that you invested. For example, if you're buying a $250,000 house and putting $50,000 down, but then after 2 years the house is now worth $275,000, well, you've already made a 50% unrealized gain on the money that you invested, even though the asset only went up by about 10%. And this is just on appreciation alone, not even taking into account the other 4 ways that real estate can make you money. On the other hand though, if you had put $25,000 into a stock in the stock market and this had gone up 10%, then you would only make that 10% or $2,500 rather than a 50% return. And this is the power of leverage. The second benefit of leverage is the increased buying power. Using the same example, if you were to buy a $250,000 house with all cash, you would have one house, and that fully paid off house may make you $2,000 per month in cash flow because you have no monthly mortgage payment. But this is also a detriment because now you have used all your cash on one property. Instead, if you use the power of leverage, you can buy 5 properties at 20% down each, so about $50,000 for each one. After spending the same amount of money, $250,000, not only will you have 5 properties that all have the potential to appreciate the same amount as your one property would have, but you also have the potential to make $800 per month in cash flow on each one. So for a total of $4,000 in cash flow per month rather than $2,000 in cash flow per month. Now Dave Ramsey says that using leverage is not worth it due to the increased risk of having so much debt on your books. But in my opinion, this debt is actually considered good debt. And if you buy the right type of properties and manage your tenants effectively and screen them before you get them and manage your entire real estate business the right way, if you do this, you should be able to manage all of the risks effectively and you should be successful with this leverage. Now, leverage is only one part of the equation, but before I start talking about Dave Ramsey's principles on paying off existing real estate debt, I want you to drop me a quick comment below and let me know what you think about leverage and if you think that it's a benefit or a detriment when it comes to investing in real estate. If you still agree with Dave Ramsey, I won't be insulted, I just want to understand your reasoning, so please let me know. Now, the next thing that Dave Ramsey is always saying is that if you didn't buy your investment property with all cash and you do have a mortgage, you should aggressively pay this down as fast as possible. And I believe this is one of the dumbest things that you can do, and not only for investment properties, but for your primary residence as well. This is because of the simple fact that paying down your mortgage faster does not increase your rate of return. Putting an extra $500 towards your mortgage every month does not make you any more money. It only saves you a little bit more on your total interest. And if your interest rate is in the 3 to 4% range, then the max return you can get is that 3 to 4%. Instead of paying down your mortgage faster, you can go invest that extra $100 to $500 per month, whatever you can afford, in the stock market, and even if it's just some safer mutual funds, in the long run, you will make a much higher return than the 4% return you would make by paying off your mortgage faster. People have a common misconception that paying off your mortgage early actually gives you a higher return. But in reality, it's just an emotional decision to pay off your debt early, which in turn takes away your buying power from more powerful investments. Now, the only caveat to this is if you have a mortgage from many, many years ago, and this mortgage interest rate is still in the 8 to 10% range. If this was the case, then I would pay this off aggressively and get rid of it. Or actually, more importantly, I would probably just refinance it so that I can get the rate down to 3% and then continue to use my money for more powerful investments. The other thing that I want to quickly bring up that's related to this is paying off other debt such as student loans early, which Dave Ramsey says everyone should do. Now, in my opinion, if your student loan interest rates are less than 5%, I would not be paying off these loans early because I can get a higher rate of return saving that money and investing it in the stock market or in real estate. But I also understand the emotions of having a student loan. If you still have some student loans, drop me a comment below and let me know what sorts of interest rates you have and if you're planning on tackling these first or investing first. Now, there's really no wrong answer here because everyone's situation is different, so don't be afraid to just make a comment and let me know what you're thinking. Now, the last thing I want to say before I close this out is I understand that people have debt, and people don't like debt, and people want to pay off their debt. But I really think that you need to look at your own situation and figure out what's best for you, whether you need to pay it off first or start investing. If you currently have debt that you're aggressively paying off and you don't really know how to invest, I think it's smart for you to learn how to invest first before you switch over to the invest first, pay off debt second strategy. Because at least you're getting a 3 to 4% guaranteed return right now from paying off your mortgages and your student loans. Once you learn how to make these higher percentages and higher returns from investing, then you should go ahead and make the switch. Now that's all I got for now. Don't forget to smash that like button below, and please make sure you subscribe so you don't miss out on any future content. Until next time.